there, this is Marc Levit again with ML Advisory. And today we're looking at Ava the entrepreneur, who's launched an RTD brand. In this section, we'll discuss some of the different ways that Ava can raise capital. At this stage in her business, we see three what are called instruments that are typically used. Convertible debt is an IOU type debt instrument that has an interesting feature. At the election of a convertible debt holder, they can convert their debt into ownership shares of the company. This allows them to have significant upside as the founders themselves have. And this debt is often accompanied with an interest rate, a time of maturity, and is sometimes secured by the company assets. A SAFE, or a simple agreement in future equity, this is something borrowed from the tech community but is getting more and more popular across consumer brands, is very similar to convertible debt in that it's an IOU instrument that can convert into equity, but it's a much simpler agreement that doesn't typically have an interest rate, a time of maturity, or is often secured by assets. So an alternative to this convertible debt and SAFE, which are often seen as similar ways to raise capital, is a priced round, where founders are able to sell equity directly in their companies at agreed upon valuation and terms. To dig deeper on thinking through whether you should raise capital via convertible debt or a SAFE or a priced round, definitely consult your advisory team. But to give you a high-level overview on both convertible debt, SAFEs, and priced rounds and pros and cons of each, convertible debt and SAFEs are relatively inexpensive to paper, they're quick, and they can facilitate rolling closings of money. So as you receive interest, you can collect on the money right away. These instruments can be secured by assets of the company, although typically small companies do not have that many assets to secure, so similar risk to some of the equity holders. A valuation of the company is not set in these structures. Rather, it's punted on in the future when all parties will have a better understanding of what the company may be worth. With that said, typically holders of these instruments include two key protections to reward the investors for their early belief in the company. There's a cap, which sets the maximum value in which the debt or SAFE can turn into equity. Effectively, this guarantees the maximum amount of dilution that investors can expect to see. And alongside that, there's often a discount, which allows investors a discount on conversion compared to a later financing round. When we looked at price rounds, what's great about them is that they spell out more terms and conditions and ways to work together, a lot more transparent in all the ways businesses can go. But as these are often negotiated in significantly more detail and are more complex, they take longer to complete and are often significantly more expensive. Price rounds will include such terms as corporate governance, information rights, budget sign-off. And the reason that brands will start with price rounds, even at this early stage, is that eventually most companies do raise capital with a price round. So some founders prefer to set it up straight from the beginning. So now that you've learned a little about the different ways to raise money, in the next section, we'll talk about setting a valuation for your company and how it leads to future rounds of raising capital.